Today is Tuesday, January 12th, 2021. We'll call the Minnesota Senate Taxes Committee to order. Welcome all. First thing we'd like to do is ask each of our members. We have some new members on the tax committee this year, and we'd like to start with just a few introductions. And so I'd like to first have, I'm State Senator Carla Nelson, live in Rochester, and represent most of Olmsted County, Rochester, Chatfield, Dover, Yoda, Stewartville, 14 of the 18 townships. I've been on the tax committee for 6 years, took a 4-year hiatus, and was the Education, Finance, and Policy Chair, and thrilled to be chairing this committee this year. Next, we have our Vice Chair, Senator Miller. Can you introduce yourself for our first tax meeting, please?
Good morning, everyone. Jeremy Miller. I have the honor of representing Winona, Houston, and Fillmore counties in southeastern Minnesota. This is my 11th year in the Minnesota State Senate.
Thank you. And then our ranking member, Senator Rest.
Good morning, members and staff. My name is, as Senator Nelson indicated, Ann Rest. I'm starting my 7th term in the Minnesota Senate, and looking forward to having vigorous discussions like we have ever since I've been on the tax committee about tax policy that in general really does avoid partisan shenanigans. So we leave that to other committees. That doesn't usually happen in our committee discussions, and it's so completely refreshing. Thank you very much. My district is District 45, first, second, and third tier suburbs of Hennepin County. Thank you.
Thank you, Senator Rest. Our members, Senator Bach.
Good morning, Madam Chair. Where are we starting? I just got on. So.
Senator Bach. Well, our first tax committee, we're just introducing our members. So we've just started with the chair, the vice chair, the minority lead, and you're at the top of the alphabet. Perhaps seniority too for members. So if you can kind of just introduce yourself, where you represent.
Well, I'm actually right behind Senator Rest in seniority on the tax committee. I was actually, when I was first elected to the House in, I believe my first time with Senator Rest, she was actually the tax chair back when I was in the House in my early years. I stayed on the tax committee a long time, even after she left and went to the Senate. Then a couple years later, I followed her to the Senate. And I didn't get on the tax committee as a freshman in the Senate, but before the term was up, I did. So I've probably been on the tax committee in the Senate probably since 2004, probably, I think. Spent time as chair from 2007 to 11. And it's a great committee, Madam Chair. Like I told you, it's the one committee in the legislature where you can learn something every day. I mean, it just kind of, tax policy is, I don't know, it's complicated, but it's very broad and there's a lot to learn. So I always enjoyed the committee because I learned something all the time. So those of you that are new to the committee, welcome. This is probably, you'll be surprised to learn, this is probably one of the more bipartisan committees in the Senate. We do a lot of good bipartisan work. There's not a lot of partisan arrows shot. We're the ones doing the hard work so that all those 12 spending chairs have some money to appropriate to things that Minnesotans think are important. So, Madam Chair, congratulations on your new role, and look forward to working with you.
Oh, thank you, Senator Bach. And maybe tell our listeners, we're being live streamed as well, what part of the state you represent.
You know, I represent District 3, which is a large piece of the Arrowhead region in northern Minnesota. So it's a little bit of Duluth. If you know Duluth, it includes St. Scholastica and up the hill. from there, the suburban communities around Duluth, like Proctor and Hermantown townships just north of Duluth, all of the North Shore of Lake Superior, the Boundary Waters, Voyageurs National Park. I often tell people that I have the district where Minnesota loves to play. My wife Laura and I live on Lake Vermilion. We've got 4 children, 8 grandchildren, and life is good. Life is good. Minnesota is a great place, and really glad to be here. And glad we have the great healthcare facilities we do in our state, Madam Chair, like the Mayo in your community.
Yes, saving lives every day. Thank you, Senator Bach. Next, Senator Coleman, a little bit about where you represent and a little bit about yourself.
Well, thank you, Senator Nelson. I am a freshman senator, previously an intern for Senator Nelson, actually. My name is Julia Coleman. I represent Carver County, District 47, which encompasses all of Carver County with an exception of a small slice of Chanhassen, which is cut out within Senator Osmick's district. As of last week, before I got sworn in, I was a member of the Chanhassen City Council, where I was a strong advocate for lower taxes, really protecting family and small business budgets. So I'm really honored to be on this committee. Fun fact about myself, I'm really jealous of everyone sipping coffee in this meeting. I'm currently expecting twins, so that is not an option for me at the moment, but please enjoy a nice hot sip for me.
Welcome, Senator Coleman. Glad to have you on the committee. And Senator Dietz.
Hi, Madam Chair. Hi, everybody. It's nice to be back to the tax committee. I just saw Roger Chamberlain, so I guess on the alphabet he is before me, but I'll just continue talking right now. I represent Senate District 60, so I have the honor and privilege of representing East Minneapolis. So I have about 1/5 of a city and a very small portion of Hennepin County, but the area includes the University of Minnesota, Minneapolis campus, and all the surrounding neighborhoods. We have a lot of fabulous restaurants and entertainment venues that I hope once COVID is over, everybody can come and check them out because they're a great place to live and play when you are in the metro area. So excited to be on the committee. Thanks.
Thank you, Senator Dietz. Senator Chamberlain, no stranger to the tax committee. Welcome. If you could just introduce yourself briefly and where you represent.
Good morning, Senator Roger Chamberlain. I live in Lino Lakes, Senate District 38. Beautiful area, urban, rural, suburban, rural. Glad to be back. Good to see all of you, and looking forward to a great session. Thank you.
Terrific. Thank you, Senator Chamberlain. Senator Klein, welcome to the tax committee.
Thank you, Madam Chair. My name is Matt Klein. I represent District 52, which is just south of the metro, south of St. Paul, Mendota Heights, West St. Paul, Inver Grove Heights, South St. Paul. As I enter my second term of office, I actively pursued membership on this committee, and I'm tremendously privileged to have been granted that honor. I did it because it seemed to me that the senators I admired the most found their way to this committee: Senator Bach, Senator Dietz, Senator Rest, Senator Miller, and I figured there must be something pretty good going on. I'm impressed by the words of Senator Bach that there's something to learn here every day. That's part of the source of excitement for me, and also just the possibility of getting to really understand and have influence on how the Senate works.
Thank you, Senator Klein. Senator Weber, Property Tax Chair. Welcome. Introduce yourself, please. Senator Weber, are you there? You might be on mute.
Sorry, biggest accomplishment of the day is remember to hit the unmute button. So anyway, thank you, Madam Chair. Bill Weber from Senate District 22. I live in Laverne. Senate District 22 is comprised of all or parts of 9 counties in the southwest corner of Minnesota. My district has approximately 72 miles of border with South Dakota and 60 with Iowa. And so we watch people move across the line, go through our district to move across the line all the time. And so it's always been of interest for me to be on the tax committee and talk about the issues that face us, and while providing for our people and in a fair and equitable manner. And so I have, as a result, I have 9 county boards, 20 some city councils, and many township officials that I have to work with. And And so they are all very interested in the tax situation, and particularly property taxes. And I look forward to being here. This is my 9th year in the Senate. This is my first year on the tax committee, and I look forward to working with all of you.
Thank you, Senator Weber. Well, members, it is an exciting committee. The tax committee is where a lot of the action is. And also, as has been said, there's something new every day, and we're seeing those new tax notes come out on a regular basis here, as far as some things that are happening at the federal level as well. Just a brief note about a committee structure for the session and then for today. We are currently in a digital mode for our committee hearings. We're hoping that February, perhaps, as soon as safety health allows, we will be in more of a hybrid model, which will allow members to still participate remotely, but we will also be hosting our tax committee meetings in our beautiful Capitol in room G15. That is the plan. We'll have to stay tuned and see how the vaccination rollouts go and how the coronavirus continues to go through our communities. But hopefully we'll be together, some of us, in person soon. For right now, we'll be offering our tax committee meetings virtually, remotely. The public is able to watch these live on I believe, YouTube. I think there's a link for that should be at everyone's disposal so that the public can be involved. That's very important that we have the sunlight of public on our committees. Today we have a pretty full agenda. We are going to have an overview from our nonpartisan Senate staff, and I'd like to turn it over to them at this point. Members, I know that there may be questions and comments. As I said, we do have a pretty full presentation today. I would ask that you hold your comments to the end of the presentation. So please be sure and write down what slide number you might have a question on, and then we will take questions at the end of the presentation. With that, we'll turn it over to our Senate staff. But before I do, I really want to introduce our staff, our committee administrator, Brian Steinhoff. If you could just say a brief hello, Brian, so people can see you on the screen.
Good morning, members. I've been with the tax committee. I think this is my 5th session in a row at the tax committee. So I'm looking forward to a new makeup of the committee and a fun session this session. So thank you.
Thank you, Mr. Steinhoff. I'd like to introduce our new committee legislative assistant. Welcome, Madeline. Madeline Hoy, if you could introduce yourself briefly for the committee.
Hello, everyone. My name is Madeline Hoy. This is my first year at the Senate, so very excited to be here and excited to work with you all.
Thank you, Maddie. Our research, Dan Mickelberg.
Good morning. Good morning, Madam Chair and members. It's a privilege to again continue to serve the committee. Dan Mickelberg and work with the Republican caucus staff.
Thank you, Dan. And our DFL researcher, Krista Broton. Please introduce yourself.
Hi, members. I'm Krista Broton. I'm the DFL research staff for this committee.
Thank you, Krista. And then our researchers, our nonpartisan researchers and our Senate counsel first, Nora Pollak.
Thank you, Madam Chair. Members, good morning. I'm Nora Pollak. I cover income and estate and sales and excise tax issues. Next month, February, will be 10 years for me with the Senate, which I can't believe it's gone by so quickly. So I'm looking forward to working with all of you this session.
Thank you, Nora. Eric Silva, please introduce yourself, researcher, and what perhaps area you're focused on.
Thank you, Madam Chair and members. My name is Eric Sylvia, and I serve as co-counsel with Nora Pollak. I handle property taxes, tax increment financing, minerals. This is my 10th session, and I am originally from the Boston area, so especially when I talk about market value, you will perhaps hear my accent. I'm used to kind of getting smirks and smiles, so I look forward to seeing that on the screen this year.
Thank you. And our fiscal analyst, Jay, if you'd introduce yourself for the team, please.
Hi, and good morning, everyone. My name is Jay Wilms. I'm the fiscal analyst for the Taxes Committee. Actually, on Thursday of this week, it'll be my 8th year with the Senate. The first 4 I spent as the fiscal analyst for the Education Committee before moving to taxes. I'm happy to be here with everybody this morning.
Thank you, Jay. And Bjorn, please introduce yourself.
Thank you, Madam Chair, and good morning, everyone. My name is Bjorn Arneson. I'm the legislative analyst for the Taxes Committee. I started within a month of Jay, I think, back in 2012-13. So this is my 9th session. This is my 2nd session with the Taxes Committee. And prior to the 2020 session, I was working with the K-12 Committee in the Senate. Glad to be here. Thank you.
Thank you so much. So as you can see, there's a lot of carryover from the Education Committee on this committee. I think that's a good background for our Taxes Committee. So let's turn it over to our nonpartisan staff to go through a brief run through about some of the fundamentals of our tax committee and pieces that will be important for us as we move forward in determining good tax policy. So I think we're going to start with Mr. Wills. Jay, are you up first?
Oh, yep, thank you. Sorry, just trying to pull up my screen here. Okay, thank you, and good morning, everyone. As you know, I introduced myself earlier. I'm Jay Wilms. I'm the fiscal analyst. I work closely with others on our team, and we're working for Senate Council Research and Fiscal Analysis, a nonpartisan organization within the Senate that, like its name suggests, provides fiscal, legal, and research services to the senators. We work with the senators, but we also work with citizens and others within the policymaking community broadly. So together with my colleagues, we're here to give a brief overview of the major components of the state's tax revenue system and outline some of the legislative and oversight work that has traditionally been within the jurisdiction of the Taxes Committee. On the next slide, we'll look at the outline for the presentation. First, we'll discuss the revenue from taxes. That's a lot of pie charts and bar graphs. And then we'll move into a more detailed look at some of the major taxes, income, corporate franchise, sales. Then we'll take a closer look at property taxes, both at the state and local level. And then we'll look at another budget area that is within the Tax Committee jurisdiction, and that's the property tax aids and credits area. Finally, we'll try to wrap it all up by looking at some charts that put everything, the whole picture into perspective. So our purpose this morning is threefold. First, to outline how the state funds the public services it delivers, but also helps fund other units of government and the services they deliver. But also the amounts, large amounts in many cases in that endeavor. The second purpose is to describe some of the major components within this revenue system and how they operate. The first part, as I mentioned, will be on the major state taxes, and the second part will take an in-depth look at the property taxes, which is of major consequence to local governments, cities, counties, townships. And then finally, another purpose of the presentation is to introduce ourselves and the research and legal areas and the issue areas that we are responsible for. This is important for the newer members of the committee, but especially those who are new to the Senate. So we'll cover a lot of ground and topics here today. And as Senator Nelson mentioned, we've reserved some time at the end for question and answer. But also, please feel free to reach out to any one of us individually should you have any questions. All right, on the next slide, this is a pie chart of the state revenues by category for all funds. So this is the 30,000-foot view of Minnesota's operating budget revenues as forecasted in November for the upcoming biennium fiscal year 22-23, for which the legislature will be budgeting. This pie chart covers the 45 or so funds that are within the state's operating budget and divides the revenue into categories, the revenue for these funds. So as you can see, in total, the state is forecasted to receive $93.7 billion over this 2-year period. And so the purpose of the slide is to show roughly where state tax revenues fit into the overall revenue picture. As you can see, taxes comprise nearly 2/3 of the revenues. Federal grants is 1/3, and then the remaining 6% is all the rest. To put it into perspective, 92 billion approximately is the market capitalization of a company like John Deere. The taxes component is more on the variety of a progressive insurance company, so just some scale. Another thing I want to note before we go to the next slide, and this is true on all the slides, the dollars are in thousands, so just add 3 zeros at the end of each, 56 billion, and these are based on the November forecast data. So moving on to the next slide. It looks like I lost my video sharing screen. Oh, there it is. Okay. So this slide looks at another 30,000 foot view, but it's a different angle. So this looks at total state and local own source revenues. So this cuts out federal grants and any intergovernmental transfers that occurred. So any aid that flows from the state down to lower entities. So it basically looks at taxes and non-tax revenue, fees, enterprise amounts that are received for services provided. So as you can see, the state and local government, approximately 75% of the revenue picture is made up from taxes, where the other 25% is of non-tax sources. And on the next slide, what we'll see is that this mix is highly dependent on the type of government. So for instance, state, 86% of its revenues at the own source level, cutting out federal grants, are tax revenues. At the local level, you can see in non-school, it's more of an even mix between tax revenues and non-tax revenues. With schools, it's a little closer to the state, and then we finally get to the total own source picture at the last slide. It's a little bit different from the previous slide just because it's a different fiscal year, but it's roughly the same, 25%, 75%. Now, if we go to the next fund, this chart really zeroes in on the taxes pie chart wedge from slide number 3. So this, as you'll remember, this is the 60% wedge, the 2/3 for all funds. This totals about 56.6 billion, and the bar chart here shows the proportion. Now, a lot of these funds are reserved for specific purposes. 85%, the vast majority actually go into the general fund. But this picture looks at some of the broadest scale possible. For instance, fuel taxes, those will flow into transportation dedicated funds, which are the purview of the taxes, or not the purview of the taxes committee in the specific sense, in a general sense. So if we go to the next slide, what we'll look at here is this zeroes in on the tax, non-tax picture for the general fund. So the previous slides were all looking at all funds revenue, and this shows the general fund. So the total is 49.1 billion in total revenues, with about 97% of it coming from tax resources. And so if we go now to the next slide, this is same chart as before, but instead zeroes in on the general fund taxes. So these are the unrestricted taxes. The purpose of these revenues is not specified specifically in law, so it flows into the general fund as opposed to a special revenue account or some other fund dedicated for that purpose. Finally, one thing I should note before I go forward is that There's another component of the revenue picture, and a lot of people might refer to it as spending through the tax code, and those are tax expenditures. So it's a big piece of the budget picture that none of these charts will really capture, but is captured pretty common report published by the Department of Revenue. And it's important to look at not only the revenue comes in, but also the revenue that is quote unquote left on the table. And so that's just an important piece I'd like to mention before we move on to Ms. Pollak and her slides, which take a closer look at these taxes.
Ms. Pollak.
Thank you, Madam Chair. As Mr. Wilms said, I'm just going to be talking about a big picture of some of the major components of the income and estate and sales and excise taxes that we have here in Minnesota. And I'm going to start with just a very basic calculation of our individual income tax and corporate franchise taxes. For individuals, the starting point is federal adjusted gross income, or FAGI, as we'll all probably come to call it. So this is the Internal Revenue Code defines income as essentially all income from all sources. And then there are some things that are specifically excluded from gross income, which are listed in that text box below there. So things like gain from the sale of a principal residence, certain education assistance payments by employers. I should also say right here that these text boxes and the bullet points are just examples and are kind of things that we might all be more familiar with, but they are by no means exhaustive at all. Another thing to remember with the calculation of FAGI is that not only are there items that are by definition excluded from gross income, but there are also adjustments from gross income. So things like interest on education loans, health savings accounts, certain teacher expenses, certain trade and business expenses. So once we do all of that calculation at the federal level, we'll go to the Minnesota additions and subtractions. And again, so these are additions that we would add to our federal adjusted gross income and then apply these subtractions, many of which I think we'll be familiar with, certain K-12 expenses, 529 plan contributions, certain Social Security benefits. So at that calculation, we arrive at our Minnesota taxable income. And then if we go to the next slide, we then apply tax credits. And there are non-refundable credits, which can reduce our tax liability, but not below zero. And then refundable credits reduce tax liability below zero. So if any of those credits would apply, you'd get a refund. And so once you apply all of your credits, you have your Minnesota tax liability. And that would be your taxes owed in April, or possibly a refund check coming your way. On the next slide, this is just some basics about calculation of the corporate franchise tax. The starting point here is federal taxable income, which is federal adjusted gross income minus federal deductions. And so these are kind of what we think of as itemized or below the line deductions. I'm just trying to find my slide here. So once you get to federal taxable income, again, we'll apply the Minnesota specific additions and subtractions, and you get to your Minnesota taxable income, subtract any applicable credits, and you'll have your Minnesota tax liability. Moving on to the next slide. The rates for the income and corporate franchise taxes. For individuals and also S corps and partnerships are taxed in the same way as individuals. We have 4 rates across 4 brackets, 4 income brackets, and those brackets are adjusted annually every year. The corporate franchise tax is a flat rate of 9.8%. We might spend some time talking about the alternative minimum tax, and I would just bring this to your attention. It's kind of a parallel to the corporate franchise and individual income tax, and it affects taxpayers with large amounts of deductions or other preference items that would significantly reduce their regular tax liability. And so the AMT was kind of created to operate in a parallel way so that taxpayers will calculate their tax liability first at the regular calculation, and then if the AMT is triggered, taxpayers would add back certain deductions and preference items, and then apply the AMT rate at that level at which the AMT kicks in. Moving on to the next slide. So this is going to be a big topic, I think, this session, federal conformity. So because our starting point for Minnesota taxable income is based on a federal point, FAGI for individuals and FTI for corporations, any changes in the Internal Revenue Code to the definitions of income or the calculations of income at the federal level could affect Minnesota taxable income. And importantly, we are a static conformity state, meaning that we adopt any changes to the Internal Revenue Code as of a certain specific date. So under certain circumstances, a change could be made at the federal level. And if we don't, and if our date is in the past, before that federal change, we would not adopt or conform to those federal changes. And we must proactively, legislatively adopt or conform to those federal changes. And there was a big case in the early 70s that kind of really highlighted this issue and made sure that we defined our income the way that we, the state of Minnesota, intended to. That case involved a deduction claimed under the federal Internal Revenue Code, and there was a dispute about whether it could still apply at the state level. And the court essentially, this is the Minnesota Supreme Court, essentially said, states can't delegate away their taxing authority, and so we have to be very concise and affirmative in how we define income. The feds can't define income for how the state wants to define it. In 2019, we significantly modified our tax code following the federal TCJA, and the TCJA made a lot of changes to the calculation of federal taxable income. And so at that point, we decoupled from the feds in the calculation of federal taxable income. And that's why for individuals, we have our FAGI starting point. And as you also are aware, in the last several months, there have been significant federal tax changes. The Consolidated Appropriations Acts, the CARES Act. And so conformity, the discussion about conformity to these provisions will be a big part of the committee this session. Moving on to the next slide. Just a few things about the estate tax. Again, we have a calculation starting with the federal taxable estate, Minnesota additions and subtractions, and then you arrive at your Minnesota taxable estate. And like the income tax, there are 5 rates that are spread across 5 brackets. One thing I would note is that we have a subtraction for qualified small business and farm property. And this subtraction was designed to allow taxpayers to to get a deduction from their estate tax liability by keeping certain businesses within a close family group. So property has to meet certain requirements at least 3 years before the decedent's death, and then qualified heirs must continue to own and use the property in that same way for 3 years after death. If those requirements are not met during that 3-year after death period, there's a clawback of a recapture tax that applies. Moving on to the next slide, sales taxes. So a different topic. There's a 6.5% general state rate, and then the legacy amendment rate of 0.375%. So the state total sales tax rate is 6.875. And any applicable local sales taxes would apply on top of that 6.875. And I'll discuss local taxes in just a moment. But just a few comments about the sales tax base. The rule of thumb is that tangible property and specified digital products are subject to tax unless they're specifically exempted. The exemptions fall into kind of 4 categories that are listed here. Our big general exemption is clothing, of course, and then there are a few other examples here. Again, these items in the lists here are by no means exhaustive, but they are kind of the most maybe familiar examples. Business-specific exemptions such as capital equipment, exemptions for nonprofit and governmental groups. I would note here that there are some limitations that have come up quite a bit in the tax committee in the past. So limitations and parameters on the exemptions for governmental and nonprofit groups. So for example, there's not a blanket exemption for sales to nonprofit groups. So that's something that has come up in the committee in the past, and whether to kind of move more completely or fully in that direction. And then finally, there are construction exemptions for specific projects. And then finally, services. The other rule of thumb there is that services are not subject to sales tax unless they are specifically included. And this list is much smaller. Again, here, not exhaustive, but there's really just kind of maybe 2 handfuls of items that are subject to, that are services that are subject to sales tax. So cleaning services, certain installation, dry cleaning is another one. Next slide, please. Another thing that I would note about sales taxes is that we're a destination sourcing state. So the Minnesota 6.875 rate and any local applicable taxes would apply to taxable sales that are made in person in the state or brought into the state, and that also are made online for delivery to customers in Minnesota. I would also note that we are a member of the Streamlined Sales and Use Tax Agreement, or we generally just call it Streamlined Sales. And this is a multi-member organization whose purpose is to simplify and modernize sales and use tax administration. And one thing, I guess, just to be aware of is that changes to our sales tax laws must comply with the Streamlined Sales requirements. And we will get called out if we enact a law that is not in compliance with those requirements. Just a final thing on the sales tax. Use tax is the complement to sales tax and applies where it's not collected by the retailer. Moving on to the next slide. I won't cover this whole slide verbatim, but as I mentioned, there are local sales taxes that may apply. And local governments have to come before the legislature to seek approval before they enact a local sales tax. And there were some significant changes made in 2019 to how local governments must go about enacting their local sales tax. Significantly, there was an affirmative statement in that legislation that the local sales taxes can be used only for capital projects that demonstrate a clear regional benefit. And so the process for adopting the local sales taxes are outlined here under these significant changes in 2019. So importantly, the governing body of the jurisdiction that seeks to enact a local sales tax has to come before the legislature before they can seek approval via voter referendum on their on whether to impose the sales tax. And they have to demonstrate that the capital projects that would be funded by the local sales tax have a clear regional benefit to people outside of the jurisdiction. I would also note there are things that we call special taxes, and these are specific taxes, so things like lodging, food, and beverage that are generally administered by the local jurisdiction. Those are not subject to voter approval the way that general local sales taxes are, but they must be approved by the legislature. One exception to this is that there is an authority for local governments to impose a lodging tax of up to 3%. That is not required to be approved by the legislature. Next slide, please. And then finally, some other state taxes, excise taxes that apply to specific goods. And these taxes, these are not paid by the consumer at the point of sale, but I think we can assume that the tax is kind of absorbed into the price that we pay at the point of sale. So alcoholic beverages, they are based on the percent of alcohol of the beverage by weight for beer and then by volume for other alcoholic beverages. Cigarettes and little cigars are also taxed in the same way that cigarettes are. Tobacco products, and then the mortgage registry and deed taxes. Next slide, please. And then finally, the charitable gambling taxes. There are two kind of sets of taxes on charitable gambling, depending on the type of game. So we have the 8% flat tax on bingo, raffles, and paddle wheels. And then the combined net receipts on these other games, pull tabs, non-sport themed tip boards, and e-linked bingo. And that the combined net receipts is a graduated tax across 4 brackets of net receipts. And I believe that is it for me. And I think, yes, I will turn it over to Mr. Sylvia to talk about property taxes.
Thank you, Madam Chair. Thank you, Madam Chair. Members, switching gears towards property taxes, the next several slides talk about the property tax system, the players, and ultimately how property tax liability is determined. The first slide, slide 20, is sort of the property tax players. And the first bullet point notes that in Minnesota, taxation is the rule and exemption is the exception. So the default is that all property is taxable in the state unless it's specifically exempted. And I will talk in a few minutes about the property that is exempted. Under local property tax, we have sort of 3 offices that are primarily responsible for determining your property tax liability. In some smaller jurisdictions, these offices are combined, but typically they're the assessor, the auditor, and the treasurer. The assessor will value your property, you determine your classification. Your county auditor would calculate your tax rate, compute tax, and prepare your notices. And lastly, the treasurer will mail the statements and collect the tax. The state also plays a part in property tax, and I've noted 3 different ways. The Minnesota Department of Revenue assesses certain property, being railroad operating property, so think of your tracks and things like that, air flight property tax, and pipeline and utility property. So the Department of Revenue assesses those types of property, not the locals, but once the Department of Revenue determines a valuation, then the Department of Revenue submits that valuation to the counties to use in determining tax rates and tax liability, but the assessment itself is not done at the local level. The State Board of Equalization is the Commissioner of Revenue who reviews the county assessment practices and makes sure that counties are assessing property properly and equalizes those values. Lastly, the State Board of Assessors sets certain training and course requirements for assessors. There are a couple of different levels of assessing property, whether it's income producing or not. And there's different levels of assessment practices. Moving on to the next slide, there are several property tax terms that many of you are probably aware of that are unique to the property tax system, and I've outlined them here. will use market value and taxable market value and referendum market value option, but they all sort of mean something different. Market value, of course, is what the county assessor looks at and determines, and that's the usual selling price based on similar properties in a sort of competitive open market. Taxable market value is your market value used in calculating property taxes, and I'll have a separate slide on determining how you get to taxable market value in a minute. Referendum market value is market value used when we're talking about school operating referendum levies, and all classes of property is including this except ag property, cabins, and post-secondary student housing. I'll have a separate slide on classification, but those familiar with the property tax system know that each property is designated as a separate classification. Each classification also has a separate class rate. Net tax capacity is a term that is often referred to in terms of what a property's net tax capacity is, and that's calculated by multiplying your property's taxable market value by the class rate. Lastly, a property tax levy is the amount of property taxes collected by a local unit of government. And when we think of property tax levy, I think many people think about counties, cities, school districts, and those are, of course, the big three that set property tax levies. But there are also other special taxing districts that have levy authority, thinking of watershed districts, metropolitan council, and there are also other types of local government entities that have, they don't have levy authority, but they have what we like to call is sort of taxing authority because they submit a levy request to the county. I think of soil and water conservation districts that don't have the power to levy and certify a property tax themselves, but they submit that request to the county. So there are a lot of different units of government that have levy authority, and whether it's directly through the organization or through the county board. On the next slide is a discussion on property tax exemptions. And I noted on the first slide that sort of taxation is the default unless specifically exempted. And there are two places where property is exempted in the state. And this first slide talks about the constitutional exemptions. And these are the exemptions that you would typically think would be exempt. These are your cemeteries, your schools, your churches, things of that nature. Of course, these are in the Constitution, so changing or removing these specific property tax exemptions would require a constitutional amendment. When we look at property tax exemptions, whether they are by statute or by constitutional application, we look at ownership, use, and necessity of ownership to determine whether the exemption is appropriate. There may be situations where a property is exempt either by the Constitution or the state, but then that property is then leased to a commercial business or some type of operation that does not fit the use component for which the exemption was originally enacted. And in that case, that property would lose property tax exemption status and would then become taxable either under personal property or otherwise. And it's worth noting that in any jurisdiction where property is exempted, all other taxpayers within that jurisdiction pay a higher burden simply because the locals, as I indicated on the previous slide, sets a total amount of taxes that has to be raised, and the number of exempt properties, of course, kind of shift that burden onto other properties to pay and make up the difference. On the next slide is an example of other types of property that the legislature has decided to exempt. These are not in the Constitution, but creatures of statute. Minnesota statute section 272.02 lists 103 subdivisions of property that is exempt. Some of these have been repealed over the years, so there's not an exhaustive list of 103 different properties. And I just have included a few that have been enacted by the legislature, and within each subdivision, there are specific requirements of what type of example. Subdivision 25 what type of ice arena or baseball park would be exempt. In this case, it's those 501c3 organizations for youth and high school ice arenas and youth hockey. Property leased to schools under subdivision 42, the legislature has exempted. Again, within subdivision 2, there's specific requirements in terms of, how long the lease has to be and what type of educational materials can be included. Agricultural Historical Society property, the St. Louis County Fairgrounds, certain property owned by an Indian tribe, and so forth. The last bullet point, or second to last, mentions electric generation facility personal property. And there are several subdivisions in 27202 that have exempted electric generation facility. In fact, I believe most personal property of electric generation facilities since the 80s have been exempt. The last bullet point I note, perpetual versus temporary exemptions. And all of these statutory exemptions are by nature sort of temporary because they're in statute and they, of course, can be amended or repealed at any time. But what I also meant by that slide is that some subdivisions include within their authorizing exemption language expiration dates. And subdivision 101, which provides a property tax exemption for certain property owned by an Indian tribe, actually includes a 10-year expiration point. So, of course, that specific property tax exemption would expire unless it's extended by the legislature. Moving on to the next slide. I think there might be one right before that on property tax timeline. Oh, okay. Property tax classifications. I mentioned earlier that each type of property is provided a classification and a class rate. So although your property is valued at the local level or by the state, if it's one of those 3 types of properties, the classifications and the classification rates do appear in statute and are set by the legislature in 273(1)(3). And property is classified according to its use on January 2nd of each year. So January 2nd each year is your classification date. If property is not improved with a structure and use is not obvious, then property must be classified at its highest and best use. In most situations, your assessor will be able to easily determine what the use is, either a residential homestead or a commercial business or an agricultural farm. But in situations where that's not apparent, then the assessor must look at the property value at its highest and best use. Each classification does have one or more class rates, and I noted that that does appear within each classification in statute, yet some classifications are divided into tiers. And what I've included here is just 2 examples of some the more common classifications, the residential homestead and the commercial industrial. And you'll notice that for residential homestead, it receives a classification of class 1A. And then following that is your classification rate separated by tiers. So your first $500,000 in value would be classed or taxed, at the 1%. Anything over 500 would receive the 1.25%. So in order for you to determine your property's net tax capacity, which is your valuation times your class rate, for purposes of residential homestead, if your home is valued at say $400,000, you would multiply the taxable market value of $400,000 times the 1% class rate. Similarly, for commercial industrial property, it's class 3, and you have different tier breaks as well as a different class rate. It's important to note that Minnesota does provide the taxpayer an opportunity to challenge both the property classification or the designation and the valuation. And your valuation notice, which includes both your classification and assessed value, is mailed to each taxpayer in March. And after that, the taxpayer has a couple of opportunities to challenge or to question the valuation and the classification rate at the local board of review, the county board of equalization, and then the Minnesota tax court. It is important to note that statute requires taxpayers to challenge these either classification or evaluation at the local board of review before going to the county board of equalization. And if a taxpayer misses the deadline, then the only opportunity for them to appeal both of these would be through the Minnesota Tax Court, which has a longer appeal process, but can be a lengthier process as well. Moving on to the next slide is the property tax timeline. Minnesota property taxes follow a 2-year cycle, and I think some taxpayers may be a little confused at this because when taxes are paid and property taxes are paid in May and October, you're actually paying those taxes based on the value that was set the previous January 2nd. So when taxpayers pay their property tax in May and October of 2021, they're paying based on the valuation set on January 2nd of 2020. And we do that because Minnesota offers a few different opportunities to become involved in the process. The previous slide I mentioned, there's an opportunity for taxpayers to question their classification and assessed value. And then in a minute or two, I will discuss sort of how taxpayers can be involved in the latter part of the process through the truth in taxation component. But this is just a breakdown of the 2-year cycle for property taxes. It begins with your assessment in January, and then it ends in October, November, when your second half of your property tax payment is due. On the next slide is a discussion on the state general levy or the state general tax. And this is a state property tax paid by 3 different types of property under 2 groupings. That's the commercial industrial component and the seasonal residential recreational component, which also includes nonprofit community service organizations. These are your congressionally chartered VFWs and whatnot that make donations. So for property taxes payable in 2021, I have next to each type of property the total property tax amount due for that section. So for commercial industrial property, it's $784 million. For seasonal residential recreation, it's $44.19 million. It's important to note that in 2017, many changes, or a handful of changes, were made to the state general levy. Most notably was that it eliminated the automatic inflator, and it also separated these 2 pots of money into separate pots. Prior to 2017, there was just one state general levy base amount, and it was structured such that commercial industrial property paid 95% and seasonal residential recreation paid the remaining 5%. But in 2017, these 2 groupings were separated so that we have a separate base amount for each. In 2019, another change was made to the state general levy, and that was to exempt the first $100,000 of commercial industrial market value from that commercial industrial portion of the state general levy. And also, this didn't happen in 2019, but for the second pot, the seasonal residential recreational, only 40% of the first $76,000 of class 4C12, so it's your cabin property, only the first 40% of the first $76,000 is subject to the tax. So although this is a state property tax, the county still collect the tax, but the proceeds are directly sent to the state and deposited in the general fund. So even though you have a local business and you will see your state general levy tax amount on your local property tax statement, the counties will collect it, but the counties do not keep any of that state general levy money. It is sent to the state for deposit in the general fund. Moving on to the next slide is the truth in taxation component. And this is sort of the second piece of taxpayer participation in the property tax process. And this was developed by the legislature in 1988, and it's designed to enhance public participation and provide more transparency. And there are 4 parts to the truth in taxation, or TNT, process. The first is local jurisdictions will certify their proposed levies, and that will happen in September. And then the next two possible specific notices will be mailed and public advertisements will be published. Those will happen in November. And lastly, you'll have public hearings where taxpayers can voice their concerns about the budget that is set or proposed to be set by each local unit of government, and try to influence spending habits to perhaps lower the total amount of levy that is proposed. State statute requires that these notices to each taxpayer be mailed on a certain date and include the amount of tax each taxing authority proposes to collect. And as I mentioned, the time, date, and location of public hearings for each required taxing authority. And lastly, it's important to note that on these T&T notices, you'll have the amount of tax that the authority proposes to collect, and those proposed levy amounts cannot be increased. The only way that could happen, and there's a notation that's always included on your T&T notice, that if there are any voter referendum levies, right, that are voted and supported by the residents at a general election, that is not included on the notice of proposed levy. So that is one way where your proposed levy could increase, but only through voter approved referendums, not through the individual taxing jurisdiction. Moving on to the next slide is tax increment financing, or TIF. And this is a popular topic for the tax committee. And we generally have several tax increment financing proposals. And I know last year, I believe all TIF proposals were scheduled for a hearing when we went remote, and we didn't hear TIF proposals. So I expect that there will be quite a few that will come before the tax committee this year. But TIF is a popular economic development tool that many of you who perhaps worked in local government is aware of. And it's a development tool that is used to finance real estate development costs to promote development, redevelopment, and housing where it may not otherwise occur. And mechanically, TIF uses increased property tax generated by a project to finance development costs. One important piece of TIF law is that before a tax increment financing district can be established, the development authority must make a but-for finding. And there are two parts to that but-for finding. First, the city must find that development would not occur without the assistance of tax increment finance funding. And secondly, that the market value of the TIF property within the district will be higher because of TIF assistance. And the last bullet point notes exactly who can create TIF districts. And I list the number of different development authorities, cities, port authorities, housing and redevelopment authorities. All of these entities have the authority via statute to establish tax increment financing districts. And onto the next slide, where I talk a little more about the type of districts. State statute provides for a number of TIF districts that can be established, and I have listed a number of them here: redevelopment, housing, economic development, renewal and renovation, and soil condition. Each type of TIF district has within its enacting legislation requirements for what type of property would qualify for each type of district, how increment can be spent, that is generated from within the TIF district, also how long each TIF district can last, or its duration. And the numbers that appear next to each district in parentheses are the number of those specific types of TIF districts that appear throughout the state according to the tax increment financing report for year ending 2018. Redevelopment districts are the most common types of TIF district, and these are the districts that are commonly referred to as districts to correct blight conditions, substandard buildings, junkyards, things like that really have no use but to clean up the property and to make some sort of development. Next, most common is your housing type of district, and that can be used for both owner-occupied or rental housing. Typically, these are for low-income rentals, and within the TIF district authorizing statute, there are again income requirements. The second bullet point, general law versus special law. All, as I indicated, development authorities have the authority to establish these districts. And the only time the legislature and the tax committee specifically will see a TIF request or legislation for a TIF district is if the development authority is seeking some sort of special exemption. So as long as the development authority establishes the TIF district pursuant to general law, then the legislature will never see that request. It's only when the district is seeking special legislation that it comes before the tax committee. And what I have listed are just some of the more common special legislation requests that the committee sees: blight test exemption, durations of the actual TIF district, or a 5-year rule extension. We typically see a few of those each year. Moving on to the next slide is, and I'll go over this briefly, fiscal disparities. It's a program, two programs really that exist, but they're nearly identical, one in the Twin Cities metropolitan area and one in the Iron Range. And it is a program for partial sharing of commercial industrial property within this geographical area. It's essentially a sharing component where each taxing jurisdiction contributes 40% of its growth to this sort of area-wide pot, and then each jurisdiction then receives a distribution related to their population and property tax base. The program itself is sort of designed for local governments to work together to generate growth that will benefit the area and help communities in different stages of development. The last slide is on minerals and mining. And minerals and, mines and facilities used in the production of taconite are exempt from both property and corporate franchise tax, but they pay a production tax and occupation tax. Their production tax is a rate set in statute, and it's based on taxable ton over a 3-year average. Production tax revenue is a major source of revenue for local governments, and it's set via statute to local governments and funds within the taconite assistance area. Corporate franchise tax, also there's a rate set in statute, but most notably about that is the occupation tax revenue does not go to local governments, but rather is deposited in the general fund. You'll note on the last two bullet points, 50% stays in the general fund, and then 40% is allocated to elementary and secondary schools, and 10% to the University of Minnesota. And that concludes, Madam Chair, the property tax portion of the presentation.
Thank you, Mr. Sylvia. Who's next with the property tax aids and credits?
Thank you, Madam Chair. That would be me.
Mr. Williams.
Okay, committee members and Madam Chair, this table looks at the forecasted expenditures by budget area. So this, the next part of the presentation will focus on some of the spending oversight and appropriations that the committee focuses on. And so this is about the general fund expenditures. This table looks at the 11 major budget areas: education, transportation, higher education, et cetera, and where they rank and the percentage share of total within the general fund and the all funds expenditures. So we can see property tax aids and credits, the third item. In terms of general fund expenditures, ranks third at about 8% of general fund expenditures. And then in all funds, it ranks fourth behind transportation, which, as you'll recall from my previous remarks, has a lot of dedicated revenues that are that flow into other funds and then are spent out of other funds. One other point I'd mention too is that what I referenced earlier, the tax expenditure budget, also, those are the spending items within the tax code. So those would be credits or exclusions or other sort of preferential treatments within. And you can't really total that budget in a true sense, but if just as an approximation, it would probably rank third right behind Health and Human Services in terms of general fund expenditures. So in general fund revenue, collect about 47 billion over the 2-year period. And then actually for the expenditures category on an annual basis would probably rank, just less than 16 billion or so. And then the property tax aids and credits. And so what these exist for is to kind of blunt some of the sharper edges of the property tax system. As you'll know, the school districts and the cities, counties don't have as many tax revenue options as the state does, and so rely more heavily on the property tax. And so the aids and credits come in to kind of assist them in delivering the services and blunt some of the impact of that, since property tax is not necessarily based on the ability to pay like income tax would be. Okay, on the next slide, this is the property tax aids and credits budget by major categories. So you can see that it's really 2 areas, local aids and refunds. The refunds being homestead property tax refunds and the renter's credit, and then of course the special targeting refund, or circuit breaker as it's sometimes called. So it's kind of a 50-50 split between those 2 major categories. And then if we go to the next slide, that takes a closer look at some of the items within there. So we see the homestead credit refund is the largest, followed by LGA CPA, and then the renter's property tax credit, police pension aid, and then school building bond agricultural aid at 131 million. And that's actually the newest property tax aids and credits budget activity. It was established in 2017 and is actually slated to grow through the planning period. It increases each year until it reaches about 70% in taxes payable in 2023. And so it'll roughly reach the size of the police pension aid. A little bit of trivia then, the firefighter pension aid, according to my notes, is the oldest, having been established in 1885. So some pretty old budgeting activities here. But I'll leave the rest of the discussion to Mr. Arneson, who will take a much closer look at these individual programs.
Thank you. Mr. Arneson.
Madam Chair and members, again, Bjorn Arneson, legislative analyst for the committee. I will, I think, go a little faster than I might normally through these last slides as we're kind of nearing the end, and I want to leave some time for questions. But hopefully the first few slides here in my section will pull together the foundational knowledge that Mr. Silva delivered and the introduction to this budget area that Mr. Williams delivered. So as Mr. Williams indicated, the property tax aids, credits, and refunds budget is in large part paid from state general fund revenues to local governments and individual taxpayers, and offsets a portion of what those local governments might otherwise have to raise for any given level of service delivery locally. Go to the next slide, please. This slide, I hope, illustrates for members where Mr. Silva started with the progression from taxable market value to local net tax capacity, or NTC, and finally then to net tax. And for my home notes here, I printed this in black and white. So the left, and if members did also, the left-hand bar in each group represents taxable market value, the blue bar. The middle bar is local net tax capacity, or NTC, and the right-hand bar in each group is green, net tax. You can see that on a statewide basis, about 50% of the statewide taxable market value is composed of residential and ag homestead property. And if we look at NTC of those, NTC of all the properties, about 45% of the statewide local NTC is those homestead properties. If we look at the next group, the commercial industrial property, you can see again on a statewide basis, maybe 11 or 12% of the total taxable market value in the state is CI property. But because of the classification system that Mr. Silva described earlier, the local NTC of those properties represents a higher share of the statewide total NTC, just in excess of 20%. And this classification system is a way to allocate the share of local taxes that get spread among different properties. Obviously, if we look at individual taxing areas, individual cities or different counties, the shares of these various types of properties are going to be, widely different in some cases. Maybe in some communities, residential homesteads comprise, the vast majority of taxable market value, or in other communities, CI or egg homestead represent the vast majority. And so, as we get into the next slides and talk about aids and credits, I hope that this chart helps frame up for members how the aids and credits budget can reduce the amount of net tax ultimately collected from individual taxpayers. Just for an example, and because Mr. Williams mentioned it, if we look at the third group of bars there, the egg homestead land, you can see that on a statewide basis, egg homestead land represents about 11% of total taxable market value. Because of the relatively low classification rate on egg homestead land, egg homestead land represents maybe 5 or 6% of local NTC. And then finally, because in part of the school bond building credit that Mr. Williams described in the earlier slide, the net tax collected from that land is an even smaller proportion of the total net tax. And there are examples like that for different types of property as well that we'll get into later. Next slide, please. If we look at the pay 2020 final levy, and this would be the levy before any credits to local governments, just to give members a sense of which taxing authorities make these levies. Again, this is a statewide total. You can see that counties and school districts are nearly equal, about 31% of the final levy. Cities and towns represent about a quarter of the total final levy. The state levy represents about 7% of the levy. And then the special taxing districts and other local levies, and the other local category includes TIF and power line levies. Those are relatively small portions of the total levy. But in aggregate, the total amount paid in pay 2020 was about $11.2 billion. Next slide, please. Now, very quickly, I'm going to go over some of the larger or more visible property tax aids, credits, and refunds, just with a couple bullet points for members to orient them to the program and purpose and kind of the scope of the program. The first two on this slide, local government aid or LGA and county program aid or CPA, are both general purpose aids to these local governments. For LGA, the formula inputs include population, city levies, tax base, housing stock, and measures of employment. There will be a subsequent slide that goes into this program in more detail, but just to give members a scope of magnitude, the 1 year spend on this is about $564 million. County program aid, very similar purpose. It's a general purpose aid to counties. The spend on this is about $264 million. Payment in lieu of taxes. This is a mechanism to compensate local governments for loss of tax base from state ownership of land. So when the state acquires land, generally that land is removed from the local tax rolls, and in the absence of this program, the taxing authority would lose that tax base. So this program offsets that negative interaction with the local taxing authority. There are several other smaller property tax aids, including township aid, which is relatively new in 2013, and those are listed there. In total, those other categories represent about $61 million in PA 2021. Next slide, please. Here's one slide just to go into a little bit of detail about the LGA program. The LGA program was launched really in 1971 as a true state aid program funded from the state general fund. And over the years, it's had various iterations. But in general, I think the legislature's objectives with the program have been to launch it as a revenue sharing program, a mechanism to provide some property tax relief, addressing various concerns about equity or the responsibilities of some local governments to provide services for commercial regional centers or other activities that make them kind of unusual in some sense relative to their population, for example. The program was last revised in 2013 session, beginning for aids in 2014. And from the 10,000 foot view, the aid amounts are based on the city's need, according to a formula, minus that city's ability to pay for those services using own source levy revenues. The city need factors are described in that table, and in the interests of time, I don't want to go into too much detail about these, but I do invite members, if they have questions or concerns about this, to contact me, and be glad to talk about them in more detail. And the ability to pay is essentially a measure of that city's tax capacity multiplied by a statewide average city tax rate. So if a city was at the average city tax rate, that city should be able to raise a certain amount of money from their tax base. And if that city's need, according to the formula, was approximately equal to that ability to pay, then the formula would indicate that and adjust the LGA amounts accordingly. There's been some interest in this recently, as the amount of LGA has shifted away from metro counties, and more of the share of total LGA goes to the rural counties now, just because of the change in property tax values in the metro area. Next slide, please. County Program Aid is a program that about 15 years ago consolidated a handful of other programs into a single program. But again, in general, it's a general purpose aid for counties. All 87 counties receive County Program Aid. It's composed of two programs, a need aid component based on the county's proportional share of statewide total age-adjusted population, SNAP households, and crime data, and then a tax-based equalization component. In 2018, County Program Aid accounted for about 4% of county total current expenditures, so it's a small but important component of county revenues. Next slide, please. Property tax credits. Mr. Sylvia indicated this earlier in the presentation, but I want to give members just a sense of kind of the scope and reach of these credit programs. The Ag Homestead Market Value Credit, I described earlier how this credit is one of the credits that serves to reduce the amount of net tax collected from agricultural homestead properties. In pay 21, this credit will cost about $36 million. In 2019, about almost 90,000 farm homesteads claimed the credit. The average credit was about $424 per homestead. The school building bond egg credit is, as Mr. Williams said, a new credit, new in the 2017 session. It has the effect of reducing the net tax collected from ag property for school debt levies only. So think of, school district authorizes a bond for a new building, a new campus. And those bonds are serviced from the school's debt service fund. The amount of the levy attributable to that portion of the school's levy is offset with a credit for ag land. The proportion of the offset is increasing over time, and under current law would reach its maximum 70% credit in pay 23 and later. And this credit in pay 21 costs about $63 million and impacts about 507 parcels statewide. You know what? I'm gonna skip the rest of the bullets on this slide. We can go to the last slide in my section. Would be the property tax refunds. This is a sizable portion of the PTAC budget area. The bulk of it is, of course, in the homestead credit refund, which is the refund available to homesteaders based on their income and the property taxes paid. This spend is about $613 million in pay 2021. Impacts about 535,000 homeowners in 2019, with an average refund of about $920. The special property tax refund is the targeting refund available in cases where property taxes increase sharply from one year to the other. It tends to be a little bit more variable in terms of the annual cost based on property tax trends in the state. Some years local governments and schools property tax increases are lower than others, and so it tends to be a little bit variable. The renter's refund is kind of the analog to the homestead credit refund for folks that rent. Again, in 2019, 337,000 renters received refunds. The average refund was about $670. And in 2021, that forecasted spend is about $243 million. And the last bullet on the slide, the sustainable forest incentive payments. This is available to owners of forest acreage with a forest management plan and a covenant in place. This impacts about 2,700 landowners. The average payment is about $4,400. There are about 1 million acres enrolled in the program. These payments are adjusted annually based on changes in statewide average values and tax rates, and it's about $13 million spend in pay 2021. Next slide, please. And finally, the other aids and payments. This was on Mr. Williams' slide. The pension aids are an important, well, the sizable component of this other aids and payment section. Historically, the state and local governments have shared responsibility for public safety pensions. The police state aid program, established in 1971, provides aid to about 400 jurisdictions and covers roughly 2/3 of local government pension obligations. The fire state aid, as Mr. Williams indicated, is an old program established in 1885 and provides aid to about 761 fire relief associations. This projected spend in pay 21 is about $156 million. There are other local government payment programs on the PTAC budget documents, including deferral programs, disaster credits, abatements, reimbursements, and other one-time aids and grants. And those account for about $10 million in pay 21. So a relatively small portion of the total budget, but important and sizable for the jurisdictions that are eligible for those programs. And that concludes my speedy walk through the major programs in PTAC. But again, I do invite folks to ask questions if they have follow-up concerns. Thanks.
Thank you, Mr. Arneson.
And Madam Chair, we have a few more slides to go through. Would you like to continue with that? I see we're close.
I see we're close to our time. I think what we might do is rather than overtax the committee, no pun intended, at this particular time with additional time, what I'd like to do, members, is I know there are questions, and I would like to, at our next hearing, we will continue with the public sector revenue system. So we'll have just the wrap up of these remaining slides, and then we'll offer time for our committee members to address questions upon that piece as well. I will just give members a brief option right now to address a few questions. I think there were a couple of hands that were raised. If members, you are able to jot down your questions so that you can ask them at our Thursday hearing, I would prefer that. But if there's something that needs to be addressed right now today over this presentation, it will entertain those questions now, and we know that we're over just a bit from our time today. And I'm not seeing any hands, and I'm not getting a notification of any hands up at this point. Let me just check again here to make sure. No, I'm not seeing, I do see one hand actually via the camera. So Senator Rest, if you'd like to offer a brief comment or question, and
yes,
we'll go more in depth next on Thursday.
Yeah, thank you, Madam Chair. We do have a number of questions for information about the presentation, and I believe that it would be most helpful if we could formulate those questions and then ask them on Thursday, so that we don't get rushed with the answers. So I vote for waiting and ending the hearing now, because other people have, some of our members have committees that are beginning now.
Yes, I thank you, Senator Rest. To that point, I was going to ask all members if you could send your questions to me and to our CA, Mr. Steinhoff. We will get those questions answered. I know the nonpartisan staff will be able to do that, and we will get those answers back to all members. So please, and thank you for that, that point.
Either way.
Good, yes. So let's just try, I know we have a few amount of hearings. We just want to, knowledge is powerful. We want to make sure everybody gets this great knowledge and then has time to ask their questions. So members, for today, if you would submit your questions from the presentation that we heard today, we will get, and if you'll submit those to Mr. Steinhoff and me, or just submit them to me, I'll get them to Mr. Steinhoff, whatever is easier for you. But get us those, if you can get those to us by the end of today, that will leave Wednesday for our nonpartisan staff to develop answers for those very good questions, I'm sure. And then staff, I want to thank you for the excellent review. I've sat through many reviews in my 10 years, 11 years now in the Minnesota Senate, and I just thank you for the background that you've provided us today, that we will be able to really take this, and it will help in our decision making going forward. I do apologize for the last person whose presentation will need to wait until Thursday. But with that, members, I want to thank you for your great attention today. It's a great committee. I'm just thrilled for the membership on this committee and the good things that I know that we will do this committee this year. With that, members, we will be meeting next on Thursday, January 14th at 8:30. Once again, it will be a digital meeting, remote, and it is live streamed on YouTube. With that, our meeting is adjourned.
Thank you.